My name is Ben David from eSignal. Hope everyone is having a great day. Before I go further, I need to perform a sound check. In the left-hand margin, you will see a chat window. Can a few of you please type yes or Y if you can hear me? Great, great. Wow, lots of anticipation for this webinar. A few more logistics before we begin. If the audio is not clear, if you hear an echo on your end, my suggestion is to try logging off Adobe Connect, then log back on. Unfortunately, there's not much else we can do to troubleshoot any audio or video issues you may be experiencing. Secondly, you can find the contact details for iReallyTrade as well as eSignal in the lower left-hand corner. Take a look at the notes section. Please take some time now or throughout the webinar to jot down this information. Please note there's also a full screen option of Adobe Connect if the images you see are smaller than you prefer. However, please keep in mind that if you do plan to participate in the chat function or ask questions of Larry or anyone on the chat box, this will disable the chat function for you. So again, there are some trade-offs if you want to go to full screen. As a thank you for attending, this presentation is being recorded and everyone will receive a copy sometime afterwards. At this time, I wanted to highlight that Larry's indicator with eSignal is only available with the current version of eSignal, which is version 12.2. A few of the things that we wanted to highlight regarding 12.2, which was recently released approximately 3 weeks ago, is it's an all-in-one, easy-to-use trading platform for you. It offers advanced, easy-to-use charts. There's a Market Screener Plus functionality, as well as an ETF scanner and content. And for those of you who like to install apps, again, we are in an app world. There are available apps for those of you looking to trade in anything from all types of asset classes or any types of indicators or add-ons that can help you in your trading needs. So again, please take a look at eSignal version 12.2, which is our latest version, and prices range from on-demand version for $45 a month to all the way to anyone who is a seasoned eSignal user on Advanced Get, which is $295 a month. We do have special promos, which I will highlight shortly. Did you know that eSignal has a special offers page? By going to www.esignal.com/specials, you can take a look at our various time-sensitive as well as ongoing promotions. Two that I wanted to highlight. Again, for those of you who are looking for a technical analysis trading platform for your needs, we offer a 30-day risk-free trial of eSignal version 12.2, again, our latest version. For those of you who are seasoned eSignal users, we thank you for your continued patronage. But we also want to reward you by letting you know that if you refer a friend to the program, to the eSignal platform, you get up to $100 credit for every person that you subscribe. For today, I wanted to highlight Larry's special offer. For those of you who are looking for access to his COT indicators report, we are offering a free 60-day trial of the COT indicators. Again, it's a 60-day trial, so you have a good 2 months to play around with it and see if it's the right indicator for your trading needs. Did you know that eSignal offers various free online training courses throughout the day, throughout the week? By going to learning.esignal.com, you can partake of classes, again, for those of you who are new to the platform, in basic eSignal 12.2. And for those of you who are seasoned in eSignal 12 or prior versions of eSignal, we also offer advanced courses in the eSignal platform. For those of you who dabble in or trade frequently using in the trade Forex or futures asset classes, we do offer various courses in those as well, for those of you who are looking for additional tips on how to trade those asset classes. In terms of upcoming partner webinars, next week we'll be featuring Mohan from Boomerang Day Trader. These and other presenters can be found again by going to learning.esignal.com. Lastly, before we begin our presentation with Larry, I want to again highlight in a bigger page some of the information we have in the notes section. Again, the website to learn more about Larry Wilms is ireallytrade.com. Here's the web address for you. If you need to reach his team, you can reach him at area code 800-209-1664. If you need to shoot him an email, it's customerservice@ireallytrade.com. Again, here's a reference to the eSignal page so you can learn more about the eSignal COT indicators. And the retail price for the eSignal COT indicator is $35 a month. But again, for those of you who want to give it a test drive, we offer a 60-day trial of the e-signal, of the Larry COT indicators. Without further ado, I wanted to formally introduce Larry Williams of ireallytrade.com. Larry has been described as a legendary trader. That legend has been based on the commitment of traders' reports. Larry is the all-time winner of trading championships. It's his students that continued winning the real-time trading contest. In this webinar, Larry will show you how to learn how to set up buy and sell signals, see how Larry uses open interest, learn when not, which is always very important, learn when not to use the COT report, get a chance to learn Larry's techniques of finding setup markets for long or short, and more importantly, just ask Larry questions about the current markets. Again, Larry would like to make this presentation informative. Therefore, feel free to send in your questions through the chat box, and Larry or I will respond in due time. However, please keep in mind, we want to make sure that Larry has ample time to get through his presentation, so please be cognizant of your questions in terms of making sure that Larry gets opportune time to get through the presentation and respond to your questions. With these final details aside, please welcome Larry Williams from ireallytrade.com. And again, thank you for attending this e-signal webinar. Larry, off to you. Larry, are you having any audio issues?
Ben, can you see my slides now?
I cannot see your slides. Do you want me to, are you able to load them, or do you want me to load them for you, Larry?
Yeah, we got them loaded. I just need to click the right button here. I apologize to everybody. It's all this high-tech stuff for an old man gets confusing sometimes. I think we're going to get it now, though. Yeah, let's do that. And we think we've got it now. Okay, oops. You see that now, Ben?
It looks like something, there we go. Go ahead, Larry, we're ready to go. We see your PowerPoint.
Okay, so bear with me a second. Okay, well, first of all, I'd like to thank everybody for being here. My gosh, I look at the names, and as I typed in, it's like Old Family Week. There's so many people I recognize literally from around the world. And I just hope I can live up to an expectation that you have to try to teach you what little I know about the COT report. It's thrilling for me to talk about the Commitment to Trader report, because this is what I've cut my teeth on in the market starting some 45 years ago. It's been really the backbone of my success in the marketplace. So to be able to share this has always been just great. And especially now that we have it in e-signal, I'm really thrilled to be able to have them support my indicators. So let's get to the indicators and go with what we're doing. I'd like to explain a little bit about the history of the Commitment to Trader report. And it really is interesting because it started from the Department of Agriculture. The U.S. Department of Agriculture used to report this thing, and I can't questions. And it came out once a month. I got it on a mimeograph sheet of paper that was sent through the mail, bulk class. So we got it about almost a month after the month that it was reported. So it was really very old and antiquated by the time we got it. But what was interesting, the fellow who turned me on to this, a gentleman by the name of Bill Meehan, who had been a member of the Board of Trade, so it doesn't matter that we get this late because it's not about timing. And that's where most people have gotten messed up when they use a COT report. I think it's about timing. As Bill explained it to me, and as I'm explaining it to you, it's a conditional or setup tool in the marketplace. This is the market's going to rally, as opposed to saying it's going to rally this particular day. It's a setup tool. So I'll talk about setup and then how to use it as an entry. It is unique to the United States. There's a loosely some similar report in Japan for the stock market, but it's erratic and it's really nothing like this at all. So we're really blessed to be able to know. Sound is working. Okay, good. To know exactly what's going on in our marketplace. It started as a monthly report in the old days. In the 1970s, I got this once a month, as I said, about a month and a half late. Then it went to every other week. It became popular. I wrote a book about it, wrote a newsletter about it, was interviewed on television and all that stuff. And more people started following this. I mean, back when I started, literally nobody wrote a single word about this. So this was a breakthrough that I was able to bring to the marketplace, and it's now very popular stuff. A lot of people use it right. Some people still use it incorrectly. We now get it weekly as of a close of Tuesday's trading. So yesterday was Tuesday. Through last night's trading report, the government will collect all the positions. I'll explain those in a moment. And that information is public on Friday, so we have it after the close on Friday. Literally nothing was written back then. There was one speech I found out about the Commitment to Trader report. A gentleman from Cargill, the world's largest commodity company, had written about it or spoke about it and that was kind of a turn on. Oh, I found this. I got to know more about it. I first wrote about this in my book, How I Made $1 Million Trading Commodities, way back in the 1970s. As I said, I cut my teeth making money in the market with this Commitment to Trader indicator. But we took the data and then made indicators with the data. Those indicators are now in eSignal. I wrote the first book on the subject, Trading with the Insiders. This was Wiley, who published so many books about the stock and future market back in 2005. So it's one of those things I'm really kind of feel good about because it's really started a whole industry of COT experts, but nobody's been with it longer than I've been. It's really created a Pandora's box of website services, wild claims, how great it is, how bad it is. There's a lot of misunderstandings. So I hope that I can kind of clear that up with you today and show you exactly how I use it. Seldom is this a timing tool. It's a setup tool. It's best used to find trades and confirm trend. Again, it's not a timing tool, it's a setup tool. Now, what has happened over the years and why I'm glad we get the information weekly now is, remember when I started trading 50-some years ago, there wasn't any internet. There wasn't any fast communication. Markets simply didn't move as fast then as they move now. So I think everything is sped up in our life. I mean, here I am in Boulder, Colorado today. I was in Colorado Springs earlier this morning. We have people from France and China. It could never have happened before. So the process of information data comes in and comes out, which drives prices quicker now than ever before. So it's good that we have a more current view of what the commercials or the small speculators are doing in the marketplace. But it's not a precise timing tool, and that's where a lot of people get lost. This is what it looks like. There's a couple of formats. There's a long format and a short format. You can Google it yourself to get the basic data. It takes a lot of work to process the data. But if you go to cftc.gov.com, you'll find that they have long and short formats for agriculture, petroleum, natural gas, electricity, metals, and others. So that's where it is. And I like the short format, and I don't look at the disaggregated futures. We've looked at that. I couldn't see that it made any difference. Now, maybe somebody was going to disagree with me. It could well be. But I have found to use it just like we've been using it for almost 50 years now. What the report will show each week is the positions of 3 different groups in the marketplace. You're going to have managed money. You're going to have producers, merchants. These are the commercials. The commercials represent people that produce a commodity or consume a commodity because they're hedging. And we have managed money, of course, the funds. In the old days, it used to be large. This group was classified as large traders. Folks like myself had to register whenever we had a position of more than 100 contracts. We had to register at the close of business that day that we had 100 contracts of pork bellies, which we used to trade, or eggs, which we used to trade, or whatever it was. Then there's other. Well, that's everybody left over. So who's left over? The public. If you think about it, you have users and producers, managed money, funds, and large traders, and what's left is the public. Swap dealers, we've looked at this data a little bit. I don't get anything out of it. And here's probably why. I mean, they're not accounting for much action here, 5,000 contracts. But look over here, the producers and users, 238,000 contracts. So this is soybean meal. Right now, we look at the commercial position as long, 92,000 contracts, short, 238,000 contracts. We can also see what percent of open interest they hold. And we're going to talk a lot about open interest in a moment here. This is really important. They hold 60% of the open interest, managed money 21%, and small traders 13%. This is pretty typical. Usually the commercials own most of the open interest. They're the largest player in the game. So that's typically the way it will be. But an imbalance of this can be very important, as I'll be talking about today as we progress. I also look at the changes. Notice that their long position was, they changed their long position from 99,000 the prior week. It was less by 8,000 contracts, and they increased their short position from the prior week. It had been 238,000 minus the 6, it would have been 232,000. So they increased their short position on this week ending. So that's what the basic data looks like, and that's all we had back in the 70s. Who would pour over this, go, oh, they changed their position and they have this position, but it was kind of hard. I mean, we didn't have computers. We had to keep all this information in worksheets, in notebooks before we could do anything with it. Now we're looking at gold. You can see gold, the commercials recently had a long position of 81,000, short position of 16,000. They had decreased, in this case, their short position. And we can look at the public over here, which I really like to look at. Wow, they're looking at that heavily long, almost 80,000 contracts long versus 27,000 contracts on the short side. Managed money was about evenly balanced, a little bit more long than short, but about even. And open interest, very interesting. The public had a lot of the open interest versus the commercials. So the big player had been the large traders, the funds, and the small traders. They actually together represented more open interest than the commercials did. That's really unusual, and is something we're going to look at. So there are three components, the commercials. And everybody talks about the commercials, but what they don't get, and this is really critical takeaway point here, the commercials are hedgers. And the commercials do not try, listen to this again, they do not try to make money trading. People say, oh, the commercials bought here, sold there. No, they hedged here and they hedged there. They are in the business of, say, growing wheat. And if a wheat farmer sees wheat at, say, $4.50 a bushel, and it costs him $3.50 a bushel, he's going to sell wheat, not because he's bearish, but because he has $1 per bushel profit. And if wheat goes to $5.50, he's going to sell more wheat because he's got a bigger profit. And if it goes to $10 a bushel, he'll sell all the wheat in his bins, if he has wheat in his bin, because he's making money at it, not because he's trying to buy or sell in the marketplace. So the commercials are not a timing tool. They're using this to offset their positions. By the same token, consider Hershey's or Cadbury, a large user of sugar and chocolate. If the price of sugar goes down, they're going to buy more sugar because the cost of their candy bar will be reduced by the cost of the sugar, right? By quite a bit. So if they can buy sugar cheaper, or if Starbucks can buy coffee cheaper now than they could a while ago, and they've been able to, they're going to buy all the coffee they can get their hands on because the cup of coffee at Starbucks price is not going to go down. So typically, it looks like commercials are buying all the way down and selling all the way up. That's a general observation that we're going to look at this to show a little bit more. Now, a question about the couple of questions have come in I want to answer. The Forex market, I'm not a big Forex trader. I think it's a very high commission market to trade. But in terms of the commercials and the currencies, oh yeah, same thing works. It's done very well in the dollar index, the Canadian dollar. So if you're going to look at the Canadian dollar versus the Japanese yen, you'd certainly want to look at the commercial position. And this is an interesting point. According to CFTC, there's a different classification of natural commodities and abstract financial commodities. And this is a critical point. This is my terminology, actually. It has always been, we have natural source markets. That would be wheat, corn, grains, meats, the metals. Those are real things, come from nature, come from God. And then we have abstract markets that man creates. Swiss franc, you never pulled one of those off of a tree, stock index futures. So, or treasury bonds. or S&P or the Russell Index. The commitment to trade report works there and a little differently. And in some of those markets, I'll talk about, it doesn't work. So in some markets, you got to be very careful of the commitment to trade report. So if you're a commercial, you're a user and a producer, and you must qualify to be a commercial. You can't just say, I'm a commercial. You have to qualify by registering as a hedger with the Commodity Futures Trading Commission. And remember, they're not making their money buying lows and selling highs. They are not trying to speculate in the marketplace. They're hedging their positions. If they think that the price of corn is going to go up, they're going to buy a lot of corn. If they think it's going to go down, they're not going to be a buyer of corn. So you don't think of these people as speculators. The speculators are the small guys in the marketplace, by and large, you people, and to an extent, the large funds. And I would say categorically that the COT report works really well in all of the currency markets. Another question has come in. Yeah, I hear this a lot. There's a camp out there that says the market's rigged. You know what? Yeah, the markets are rigged. I'm here to tell you right now, the stock market's a rigged game. It's averaged about 9.8% of return per year for the last 100 years. It's a rigged money-making machine, the biggest money-making machine you've ever seen. If you just buy stocks, upgrade, and stay with strong stocks, you're going to earn about 10% a year in your money without having to mow it, paint it, feed it, water it. So yeah, the upward drift of the stock market is huge. It's not rigged like people think. It's an unrigged game. You know, it's kind of like some people say success is just a matter of luck. And you know who says that? Losers. Success isn't a matter of luck. It's a matter of hard work and getting intelligent and having some ideas that other people don't have. So there's this whole bearish camp out there that says, oh, gold has more open contracts in it than there is gold exists, is one idea. You know, I pass that argument and just say that if you look at the history of gold, and we're going to be doing that today, you'll see the commercials are always buying at the right time and selling at the right time. And interestingly enough, I don't think they've ever been net long the gold market. So if they ever do get net long, my gosh, mortgage the house, buy gold. They have been traders of this market on an intermediate term basis. We've also never seen a premium in this market, and it's a natural resource market. If we're going to have a rip-roaring bull market, the end of the world, whatever, gold A will have a premium, B, the commercial will be net short. Will be net long. So there's a lot of poppycock about gold. Like, what happens if we have a depression? What will the price of gold do? Well, study your charts. It will go down. Yeah, it goes down in depressions and recessions. What did gold do in 2008? It went down. What did gold do in 1929? It went down. Or 1974, it went down. Or in 2002 and 3, it went down. Because gold is like any other commodity. And in a depression, people don't have money to buy things, whether it's gold. You know, the things that go up in recessions tend to be alcohol. That's almost a sure deal. So I have a long-winded thing about gold, but you really have to understand gold market is a commercial market. And it has commercial buyers and users in the marketplace. It also has large traders and large funds. And the large traders or funds are speculators. So these are the commodity trading funds you may have invested in or trying to figure out how they trade. We're going to show how they trade today. They're largely trend traders. The vast majority of commodity fund guys are trend traders. So they're buying something using something like the turtle trading system. I would estimate maybe 90% of the funds are mechanical, quasi-mechanical trend traders. And then the other, maybe the 10-15% of them are old-fashioned traders that are going to make their own decisions, and they're not necessarily a mechanistic approach to trading. So that's the difference between most of these guys are trend traders, and money management is what they're really all about. Yeah, the 4-year cycle has worked very well in gold. We got out of the gold market about 4 years ago, called the top in our annual forecast, because of the 4-year cycle. So there's a very strong 4-year cycle in gold. Has nothing to do with the COT report, right? But yeah, to answer that question, of course it does. The commercials, the large traders don't like drawdowns. So they manage your money totally different than you guys do. You think the Crable and Niederhoffers of the world are only 10 to 15%? Yeah, I would say so. The Scott Ramseys, I don't know that Tony is all that much of a judgmental trader, but certainly Roy Niederhoffer is. So is Vic. I mean, Vic's he's not a mechanistic trader at all. Okay, so, well, how about a dose of reality about these funds? How well do they do? They can do 10% a year. They think it's great. It's not very good, is it? We can't do 10% a year. If they do 18% a year, they've knocked it out of the park. It's a major home run for them. And occasionally they'll do 30%. The very, very best of the best, the guys like Paul Tudor Jones, Steve Cohen, they may have years higher than that. But on average, these trend traders do 10, 12% a year. Some years they're down, some years they're up. But they don't get the spectacular results that a discretionary trader can get. I was having dinner at Steve Cohen's house years ago, and it really struck me. Here's a discretionary trader who's made more money than anybody in Wall Street, the best trader I've ever seen, and he's not a mechanical trader. It was like, I wake up, trend trading systems work, but you need a massive amount of money and a huge amount of patience. The COT indicator is just for commodities. Yes, it only exists for commodities. However, we have a spin-off of it that does help for the stock market. Okay, so the rest, we've got the commercials, right? Then we have the large traders or the funds, and the rest of us is the crowd, and the crowd is usually wrong. Usually wrong. So that's the public, and the public gets emotional most of the time. There's some exception to this, though. There are small traders in some markets that are actually informed, like the hog market. There are a lot of people that are raising hogs, and they don't have enough to fulfill a contract or 2 contracts even, but they know the business. So they will hedge their own position, but they are informed. So you cannot make a blanket statement that the small speculators are always wrong. That's not true. In some unique markets where there's a potential for a small producer to be, these guys can be pretty good in the marketplace. So we can take the net position, we're going to look at that in a little bit, and we can make indicators out of these net positions. And we started doing that years ago. Now everybody is doing it, and I'm going to talk about those as we open them up. And we can do individual market analysis. And I like to look at the relationship of these 3 groups, the commercials, the trend, the funds, trend guys, and the public compared to open interest. So a lot of you have read my work or maybe other work on open interest. We're going to show you something today you have not seen before unless you've been like a subscriber of mine or followed my weekly commentaries on Larry TV. So this is really exciting stuff. What is open interest? Open interest is the total number of outstanding contracts at the end of each day. That's not volume. Volume is the pressure or the intensity. It's how many times we turned over price during a day. This is a number of contracts open at the end of the day. And KLH, I'll get to that question for you. Open interest measures the flow of money into the futures market. It represents the total positions in the marketplace, total positions. And commercials, remember, some are long or some are short. So some are producers, some are users, but it's the net position that we're looking at. The COT report gives us the net position so we can see when there's an imbalance of more buyers than sellers. So this is what people typically think about open interest. If we have price, volume, and open interest, and if price is rising, volume is rising, open interest rising, people typically say the market is strong. If price is rising, volume is falling, open interest is volume, they say it's weakening. Yeah, occasionally. And they say the market is strengthening. If price is down, volume is down, and open interest is down, they think the market is getting stronger. Occasionally, but this has been in every book written about open. This is not really correct. It's not nearly enough information. It's a little more complex than that. So day traders will not count for open interest. No, if they're out of the market at the end of the day, they did not increase the open interest. So generally speaking, high levels of open interest mark market tops, and low levels mark market bottoms. Not always, but as if you're looking for a really good indicator of a long-term market high, you will see invariably very high levels of open interest because everybody's interested. It's the topic of the day. Everybody's buying it because it's a euphoric condition. The opposite of that, with nobody buying it, open interest is low. So by and large, historically low levels of open interest are bullish, high levels of open interest are bearish. That on a self, just like that, that's well worth coming to the webinar today. It's just a great indicator because it shows the interest. That's all open interest is. It's the interest in the market. When everybody's interested, probably going to come down. Nobody's interested, probably going to rally. So let's look at open interest. We're looking at open interest here now in the dollar index. And if we look at low levels of open interest down here and here and here, what do we see? Market lows. High levels of open interest can be bullish. Now, how do we deal with that? Well, we're going to look at what causes open interest to come up. Generally, though, relatively high levels of open interest are seen at market highs. High levels of open interest are seen at market highs as a general rule. Here's gold. Very high level open interest, close to market high. This is high level of open interest on a relative basis. The most open interest we've seen for quite a while, market high. So we still need to know, though, who's causing that open interest to go up or to come down. That's the really interesting point. Here's the bond market. In the bond market, we see high levels of open interest in the market bottom. So we need to ask the question, who was causing open interest to come up? That's the critical point. But again, low levels of open interest, market lows, low levels of open interest, market lows, generally speaking. Here's a more current example of gold in the commercial position. Now we're looking at commercial position, not open interest, but the commercial position. This is the biggest long position they had for quite a while. That's the red line. This is their net position, and gold rallied. Then they got excessively short. Notice this is the biggest short position they've had for a year or so, and the market falls out of bed. And again, a large short position. The line's down here, and again, we see the market come down. So a question, what time period do you use to determine high-low open interest? I don't use any time period at all. What we're looking at now is just the net position of commercials, or what we were looking at is just the net position of open interest. So that's all. We can look, most everybody's got an index, but you know what? I think there's more valuable information to look at the net position. I apologize. This is the net commercial long position in the bond market. And look how low it is. They were not buyers up here. They were buyers down here. Low levels of open interest here associated with market highs. Does open interest equally apply to Forex? Yeah, sure it does. These are universal ideas in the markets. Here's soybean meal. Wow, very high level of open interest here. On a relative basis, high level of open interest. Of commercial activity. I apologize for that. High levels of commercial activity, market low. High levels of commercial activity, well, great place to be a buyer. Low levels of commercial activity, look for a peak. We made low levels of commercial activity here. Market fell out of bed. High levels of commercial activity. In fact, at this point, that was the largest buying commercials had done for quite some time, and the market rallied. Now, a really interesting question has come in. Does this work for the S&P futures? No, it really doesn't. Well, why? Because my belief is, remember, these large commercial interests are hedgers. So you have people that have been selling the heck out of the S&P. They're not bearish because they're offsetting that with the spread buying the Shanghai index, or maybe buying the Russell, or buying the DAX, markets that have been appreciably stronger than the S&Ps. So on the hedge basis, they're bullish. They just have a bull spread on. They're short the S&Ps and long another stock index. So you cannot take all of these rules to the S&Ps. I was going to say, as I mentioned earlier, there's some markets where it doesn't work. It works kind of, but really not very good in the E-minis. Don't we wish it did? It used to. But now with all this spreading going on, it's not as effective as it once was. And yes, I am paying a lot of attention to the extremes. I like to see extreme readings when everybody's crazy bullish or bearish, those are the most significant readings in the marketplace. Now this is large traders in bonds. Notice the large traders were very bullish up here. They're very bullish here, and they're not bullish down here. In other words, what this is high, they've been doing a lot of buying, right? They weren't doing much buying here, and the market rallied. We'll look at these points. You're going to look at the commercials in a moment. We'll go back to that chart. Not much buying by the large traders in these points. If we go back a couple of charts to bonds, wow, look at this. The commercials were buyers here and buyers here, and the large traders, as we just saw, were not. So I do like to use those. Another question. Oh my gosh. Can you repeat later which market you trade? I'll tell you that right now. Soybean chart seems to work opposite. Like soybeans work really well with open interest stuff. So here's a question I get all the time. Larry, what markets do you trade? Like there's some mystical magic market, right? You know what market I trade? You can write this down. I trade the market that is the most set up at this time. So I'm not in love with gold or bonds or S&Ps. I traded the S&P quite heavily with some mechanical systems. But for my long-term position trades, I'm a conditional trader. I wait until I get a lot of conditions there that I have COT, because it does work on all commodities, with the exception of what I've noted here. So I wait for a condition, and when there's a massive amount of buying or selling in a market, here's gold with the large traders. Look at this. The large traders were heavy buyers here and very heavy buyers right here. So that's a conditional market. So of course I want to look to be a seller here. And at the market lows, when we rallied in gold, these guys weren't buying, were they? Very low levels of long activity in the market. Remember, the blue line is the net position of large traders. The question keeps coming in. Does it work with all futures? Well, I've talked about where it does work, where it doesn't work. But by and large, yes, it works with all futures. Here's soybean meal. Remember we saw when the commercial were heavy buyers up here? Well, look at the large traders. That was the lowest long position they had for years. Look what happens. Interesting, huh? So I do like to see extreme levels. This extreme level, this high level is the most bullish they've been for quite some time period, and the market falls out of bed. Then we have the small traders. I have in each signal we've color coded, so we have the large traders in blue, small traders in green, and the commercials in red, because they are the driving force in the marketplace. So here's the small traders in the bond market. Ooh, look, the high in the bond market, the small traders were the most bullish had been since when? Back here, another market high. Very bearish, not buying any bonds down here. Oh, a substantial market low. Then what do we get up here? A high level of long positions by the small traders, and the market falls out of bed. And questions come in, how do you define exact time to open position? Well, again, I'm not really concerned about the trader report as a timing tool. It's a setup tool. So when I see the market shows me that the small speculators are crazily long this market, or they won't touch the market with a 10-foot pull, then I'm going to look for a signal to get in. What would I look to get in? See, most of you want to know, when do I get in? When do I get in? When do I buy? When do I sell? That's the last thing I look at. The last. I'm looking at a confirmation that a trend has changed. So there's a lot of simple things you can use, like a trend line, like getting above a short-term moving average, like making a higher short-term low. A lot of whatever changes trend. When the small traders are very bullish, any trend change signal is going to be probably pretty good. Look how the bullish they got here. Oh, so let's take a trend change, right? So in my world, it goes condition, setup, then trend change for my entry into the marketplace. Here's the small traders in gold. Look at these guys. That's the most bullish they had been in the history of the gold market, right there. No wonder we went short gold here, right? And then when they're not interested in buying, the most bearish they've been for a long time, ta-da, we get rallies in the marketplace. How about that? So small traders are not necessarily totally behind the curve. They actually, at their extremes, are dead wrong most of the time. How do I determine which contract to trade? I always trade the nearby contract, the one with the largest open interest in it, because in my case, I trade it in size. I can get in and out of those a lot easier. So I want to be where there's liquidity in the marketplace. Here's small traders in soybean meal. We looked at that. Remember, the commercials were buyers here. The large traders weren't. And look at that. Look at the small traders. They wouldn't touch soybean meal, the 10-foot pole. They did up here. They wanted to buy it here. They wanted to buy it here. And of course, they're wrong. It's actually sad in a way to see whenever they get heavily long this market, as they were back here, look what the market does. Small traders are trend enders for the most part. Michael has a question here. Your indicators are not very good for exact timing to opening positions. Well, I can show you a way we can use them for timing positions, but I never said that's a timing tool. It's a setup tool. Most traders I meet with don't have a clue if the market really should be going up or down. They don't understand that markets don't move because of charts. Charts don't move the markets. You think that they do. That's why you're not successful in the marketplace. Conditions drive prices. So I want to study the conditions. Would that make more sense? To understand what price is going to do. So charts are the last thing I look at. I'm looking down here. I don't look up here. This is, my gosh, this is like really hard. It's like a Ouija board up here. Down here, oh, yeah, they're doing a lot of buying, so I want to look for a sell signal. That's pretty simple. So I don't look up here at price. Price is like the last thing I'm going to look at. I'm going to show you some examples of that in a moment. So good question, John. What levels do you consider extreme? Well, 6-month high. Here's the bond market. Yeah, this is the highest high it's been for years. So that really attracts my attention. I'm a position trader. There's not much money in day trading. A lot of fun and stuff, but you don't capture big moves that last for months when you're a day trader. And you know what? If you want to make money in the market, this is what you got to remember. Trend is the basis of all profits, right? No trend, you're not going to profit. Okay, let's ask ourselves then, what's the function of trend? Where does trend come from? It comes from time. A day trader can't catch a big trend move because out at the end of 2 hours or 15 minutes, he can never catch a big move. I can catch a big move in these markets because I'm a conditional trader. With gold and silver, would JP Morgan be a hedger or a large trader? Well, if they're managed funds, they would be a large trader. If they're commercial hedging, they would be classified as a commercial. Conditions move price. Yeah, I mean, that's everybody thinks that charts move prices. Charts don't move prices. This chart stuff up here is like chicken scratches in a barnyard. Really hard to read and decipher. You know that. You know, but you're still trying to read the entrails tossed out at midnight to see what's there. This is the stuff. Look at this stuff. Here's the commercials, red line. They're way short. The small traders way long. The blue line, the fund managers, they've been buying a lot. There's no wonder the market comes down. And when does the market bottom? Oh, look at this. The small traders are really negative on the market. The commercials have been buying and the market bottoms. Open interest in this case is pretty erratic in some markets, and you need to learn this, is that open interest has very quick peel-offs at expiration, especially in the E-mini, so open interest is a little different there, and in the bond market. But by and large, high levels of open interest are going to be associated with market highs, low levels with market lows. Very low level of open interest here, look for a low in the market. High levels of open interest here, market peaks. High level of open interest here, a market top forms. Gosh, guys and gals, I apologize. There's so many questions coming in. I don't take it personally if I don't answer your question. I'm just trying to get through all of these. If we are swing trading, does COT matter? In my book, COT matters all the time because as a swing trader, I want the bias in my favor, don't I? I want to know if I should be rallying or declining. So yeah, this is incredibly important for me. Anything other than a day trader, if I'm going to try to capture a move, 3 days, 10 days, I certainly prefer to be on the side of big money than small money, right? Commercials seem to keep buying after trend changes. Yeah, Jeff, we've talked about that. Remember, the commercials will buy weakness because, let's see if we can get an ag market. Well, at gold, they're going to buy, look, they bought all the way down. The red line is commercial buying, right? They start their buying campaign here. They buy all the way down because they're hedging. They're not accumulating a position. They're hedgers. You got to remember that. They were very short up here, and then the way down, they're going to hedge their positions. So that's where you look at the indicators and look at the extremes, not just at, oh, look, they've been increasing their long position, but it gets extreme up here. This is the highest level they've been for years, right? So now our attention is focused on the market. We are looking here at weekly charts, by the way. Can COT reports be used for spread trading? Hi, Aslan. How you doing? Good to have you here. Yes, they can be. I don't do a lot of spread trading, kind of for old men and old women, right? It's not real volatile trading. Even 73 years of age, I still want a little volatility in my trading. But yes, it can be. Okay, so let's look at these all together. Here's soybean meal. We'd looked at this earlier. Look at this. Wow, the commercials are heavy buyers. The blue line, trend follower guys, and the green line, the small speculators, they didn't want to touch this market. Have we seen that condition other times? When we see the red line really high and the blue line, yeah, look over here. Red line's really high, blue line guys are down here, a buy in the marketplace. The opposite of that would be the blue line and red line, or blue line and green line, I apologize, are really high, and the red line is low. Oh, that's a sell signal. Look, here we are again. Here we are again, sell signal in the market. Here we are again. Here we are again. So everybody's into using the commercials for indicators, and it simplifies it. But I'll tell you, I really like to look at all three parties here to see what the heck is really going on. I think that's really critical in the marketplace. Can moving averages be used for timing combination? Yeah, they can be used, but moving averages they're a random experience. We're going to be doing a webinar this coming week talking about moving averages. There's been some great reports done on them. They're very ephemeral. Whatever moving average works the best in this time period won't work the best in the next time period. They're a general idea, by and large, of a trend change. But they can help you say, yeah, trend has changed, so a moving average can help you do that. But don't look for some mystical, magical moving average. It ain't there, at least not in my 53 years of looking. And I have a lot of programmers, a lot of computers, and we never found it. What's the best timing model to enter and exit? Jake, the best model is first find a condition, and not just a commercial position. I'd like to see 3 or 4 things there. Maybe commercials, maybe seasonals, maybe a spread, maybe open interest. What's the advisors? What are the newsletter guys saying? I find a condition, then look for a trend change. That's what I do. Okay. Can net position changes by a certain number trigger? No, we don't use this to trigger trades. We're looking for setups, guys and gals. Everybody wants to make this so simple. We're looking for setups. Here's the COT indicators in the bond market again. Now what we're looking at is the indicators. We're not looking at the net position, but I'm looking at an indicator. I'll explain that in a moment. This is simply my percent R. Can use stock options open interest exchange for taking positions for stocks? You probably could. I have not studied that, Cesar, so I don't know for sure. Okay, so here we go. The green line is a percent R, and you probably all know percent R, I'll go over in a moment, of the small speculator's net position. And this will oscillate from 0 up to 100. And the red line that you see is the commercial position of percent R. So how do we do that? In the data, we take the net position of the commercials, and we take the reading this week versus the highest and lowest reading of the last 3 years. And if we are very low within that range, then in the small specs, we're going to be down here. They haven't been doing any buying. If, as an example, let's say that the range of the last 3 years has been 100 of commercial positions and no commercial positions, and the current reading is 90 commercial positions, we're going to be in the 90% area up here. So all that this is, and it takes a little bit of math to do it, but it is in eSignal now, is the indicator. And the general rule is when this indicator is above 70%, the green line here, the red line, the commercial position, we want to look for buy signals. So if you want to have a real simple indicator, we're just going to take the net position of the commercials, we're going to make that into a percent R. And we're going to use that with a 3-year look back. There are other look backs. We're going to discuss that at another time, and those look backs are critical. So when it's very high, we've broken out to a new high, higher than we've been, and we're in that 90% area up here, we're going to be taking buy signals. When it drops to a very low reading, somewhere below 30%, look where we are. When that indicator is very low, we want to take sell signals. I don't want to take a sell signal in here because I'm in a big uptrend. I always like to also take trend into consideration because trend is really significant. So here's the indicator again in soybean meal. The small speculators are not being a buyer here. They're being crazy long up here. So again, we're just going to make an oscillator out of the net position. We've looked at Bollinger Bands on net positions and on the indicators. Sure, it's helpful. You know, I have nothing but great respect for my buddy John Bollinger, but there's no magic to this. I think everybody is trying to refine this too much. Look, guys and gals, this is trading. This is saying, oh, we've got a setup here. Most likely we're going to rally. I'm going to buy. I'm going to have a stop. I'm going to have a target in the marketplace. There is nothing perfect about this business of trading. And so my indicator, John's indicator, Tom DeMark's indicator, they're a good idea. They help us. But that's all that they are. I think we're looking for some panacea. And that panacea, unfortunately, for most traders, turns into a Pandora's box. So here's how I use all this. First, I want to find a setup market. I want the commercials long and the public short. That's the first thing, right? Commercials long here and public short. Commercials long over here and public short. So we're in that 60-70% bullishness of the red line, and the small guys, the green line is real low, so they want to buy the market or they're short and the commercial buying. I want to be a buyer. So I don't have many trading opportunities, do I here? I've got one here, have one over here, I've got a little one here, I got a nice one here. So I'm not going to be buying and selling every single day. I'm using this on a weekly basis. Yep, weekly. So I'm looking for these big trades in the marketplace because I think the big money is in the big trades. Then I'm going to go to my daily charts to take a trend change signal. I got to go from weeklies to setups to daily. So there may be specific markets if you want to. We can go, I think I can go and look at each signal on my computer here if somebody has a particular market they're interested in. And here comes a big sales pitch anyway, but while you're typing in what markets you want to look at, this is probably an unheard of offering. We're going to give this information away for 60 days for free at eSignal. So sign up for it. You're going to get the commercial links, the net position of the small traders, large traders, the commercials, and the large traders. So you can really have some fun with this and look at it and play with it yourself. Because, you know, Ronald Reagan was my favorite president. He had this great line. Ronald Reagan said, "Trust but verify." And, you know, whether it's me or anybody, they have these really good indicators. Yeah, trust them. But you know what? You verify it for yourself. You better check this stuff out. My stuff, anybody's stuff. You know what? Trust it, but verify it. That's what you want to do. Okay, so a couple of questions have come in. I can't do all these markets. I'm going to make a couple notes here on markets that I see the most. So we've got soybean meal, we have corn, we have gold, we have silver, and heating oil. Okay, now guys, stop typing. I can't go through all those markets. We're going to be here till midnight, and we're not going to do that. So now, bear with me. Bear with me. I got to figure out. Hey, Trevor, thanks so very much. I've got to figure out how to get to share my screen. So let's see if we can get to our eSignal chart. And we're going to look at the markets themselves. Stay with me a second here. Howard's question, I think you look for commercials long and short. I prefer seeing the public long is very bearish. The public. So here we go. I think you can see that screen now. Doesn't look like I'm going to be able to see your questions. Maybe so. We'll see what comes up here. But we're going to be looking at current markets. habits right now that you guys had mentioned about, and I will be able to see your questions. So bear with me. I'll try to go through this. So what we're looking at now is the price of gold, okay? And we're looking at gold on a daily basis. You can actually do that on eSignal. That's really a cool thing. Now, the net position was here, and this is a week data in between here and here, okay? So just keep that in mind. Question, do we have to subscribe to eSignal charting to try the COT package? I don't know. That would be an eSignal question. Okay, so the red line, remember, is commercials. The green line, the public. The blue line, the large traders, the trend followers. Ted, if COT is not the best for S&P, does that mean the COT? Yeah, what we found the best for the E-mini is our proxy index. It's another webinar, probably another time. Okay, so where we are, I know you only care about gold right here, right now, right? So let's look at gold right here, right now. The commercials have been buying this market, right? The small specs have been getting out, so have the large traders. We're really close to a buy point in this market. Are the small specs at an extreme? That's the bigger question. I'm going to move your questions over here, and let's see if you can do this. Yeah. So are the small specs at an, let's have to repopulate here, bear with me. Are the small specs at an extreme? That's the big question. Well, they're pretty low, and this is the index that we're looking at. Bear with us, that'll repopulate for us in a moment here. I'd prefer to see them way down here as they were at the last buy point, right? So that would, but I see that the large traders are also very bearish on this market as they were at the extremes, and the commercials are also now at extreme readings. So in an ideal world, the small specs would go lower, but you know what? Look where we are right now. We are at a position right now where the commercials have been heavy buyers and everybody else is getting out of the market. So this is a daily chart, and I think that gives us an opportunity to be looking for a buy signal in the marketplace. Now I think I can bring up a net. This is the net positions chart we're looking at now. I'm going to open this chart up a little bit so we can see the net position. This is the net positions. Go to net position of gold. So this is the net positions we'll be looking at in the gold market. And open interest is the black line at the bottom down here. Now this is way interesting to me in the market. In a moment. Would you buy the strongest precious metal? Absolutely. I would want to buy whatever's been stronger, silver, or gold. And does this, there was a question I wanted to answer, and so many questions have come in, I missed that one. I apologize. Okay, so the next question people had was, what about silver? So let's take a look at silver. And now we're looking at silver, and silver price, of course, has been a huge bear market a long time period. It's probably been a little weaker here than gold, and look at what we're seeing. The commercials are not quite as bullish as they were in gold. The small speculators are about blown out of this gold market. They're not quite as bearish as they were back here. But what I'd like, they're both set up. So what I want to do would then go to a daily chart and look to see which market has been the strongest recently. That's one I would like to buy. Okay. So with that in mind, let's take a look at, there's a question on heating oil, or crude oil, I guess. We'll do crude oil. That's the bigger market. This has been a great trading market. My God. Oh, look, a very high level of open interest. Market top. High level of open interest, market top. Not only a high level of open interest, look at the commercials. While open interest is increasing, not the commercials. They were not increasing open interest, were they? The green line and the blue line, they were increasing open interest. Big surprise, the market decline? Not to us at all. Also, our annual forecast also said this is a critical time to sell crude oil. It was. We're probably going to go lower, maybe $40 in here. So where are we? Right here, right now. Getting interesting. The commercials have picked up their buying a little bit, but they're still not at real high levels, are they? All right. Small specs are pretty negative on this market, so we can rally in here. Open interest is not doing much. But the fact we've been in a big downtrend, now this is really critical. That big downtrend means it takes a while for these markets to top and bottom and get going. I would prefer to be in a market that's in a downtrend and see commercials selling it, or the public wildly bullish, as opposed to saying, oh, I'm going to be a buyer. Commercials gave a nice buy signal here. But we're in such a big downtrend, I wouldn't expect much of a rally. We continue to be in a big downtrend, so this is the market that we can rally in here, but it's not the same setup as downtrend commercial selling. I'd like to see uptrend commercial buying. I don't know if you can see this chart. Here we go, where the market's in an uptrend commercial buying. Those are good buy signals, aren't they? See the difference? Big difference. Okay, another market somebody wanted to look at, I wrote down, was soybean meal. Oh my gosh, well, let's go look at soybean meal, huh? The Nikkei, of course, we don't have commitment to trader data on the Nikkei. Remember, we only have it for the United States markets. Can your indicator show on the bottom one to be red looking for divergences? Oh, don't, this whole thing of divergences, guys and gals, there's one form of divergence that works that I found in over half a century doing this, and it's what I call reverse divergence. Markets can diverge and rally for a long time before the decline or before this. So divergence is very, 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 very careful of, okay? Be very careful of that. Okay, so we're looking now at soybean meal. Move this away because, oh my gosh, look what's going on in soybean meal. The commercials have been selling the heck out of the market. Open interest has been increasing. Who increased open interest? Well, the blue line's coming up. The red line's coming up. What do you think? What does that look like? Well, it looks like what we saw over here when commercials were getting out of the market. Small specs were buying the market, except here we are in an uptrend. Here we're in a downtrend, aren't we? We've been in a downtrend. In fact, the last time we saw that was right here. Large traders were buying it, small specs were buying it, not the commercials, and a high level of open interest. So is soybean meal going to go down? Hey, I don't know, but I'm going to take sell signals in it. I will take a trend change sell signal or whatever. Maybe there's a blow off signal. Maybe there's my specialist trap or something else. Yeah, I've got to be looking for a sell signal in this market. Isn't that cool? How we can look at this stuff and get a good idea of like, oh yeah, there's a time to be a buyer and a time to be a seller. That's what, when Bill Meehan first brought this idea to me, and Bill was a brilliant guy, eccentric guy, but Bill started 3 traders, myself, the Campbell brothers who now manage billions of dollars, and a guy named Chuck Conrad who made enough money trading that he bought a casino in Reno, Nevada. All of us springboarded from what Bill taught us about the commitment to trader report. He taught us, first of all, don't be a short-term day trader. There's no money in it. There's a lot of fun and excitement, a lot of stress, but there isn't really big money in it. You want to count big positions with, big moves with a small position. That was Bill's bottom line thinking. If you're only risking one contract and $1,000 stop loss, but that one position can have a $10,000 gain, you got a 10-to-1 risk-reward ratio. Bill drove that into our heads. small positions and big moves. Day traders, to make a lot of money, have to have a big position because how many time? No trend advantage. Oh, enough preaching to you guys. Sure, the dollar index. Let's go look at the dollar index. Okay, the dollar index. Gee, this is a really interesting market. You're going to love the lessons here in this market. We've had some really nice buy signals. Look at the sell signal back here when the commercial position was net short, high open interest, right? And look at the blue line, and the public was wildly bullish on the dollar index right here, market high, and high levels of open interest, which you now know are associated with market peaks usually, and low levels of open interest are usually associated with market bottoms. That's what's important for us to look at. Hold on one second. I'm starting to lose my battery. So where are we right here, right now? Right here, right now, open interest has come down, but are we seeing a lot of commercial buying? No, not a lot. We could go to the COT indicators because, another point, in a big uptrend, if the commercials start to buy weakness in an uptrend, that's very bullish. So in my weekly commentary a couple weeks ago, we were very bullish on a rally in the dollar index, and with the trend following stop below it now, because commercials buying at high levels also can set up another buy signal. Okay. Oh my gosh, things are coming in and off the screen faster than I can look at. Do you always look for setups in the weekly time frame? Yeah, I do look for setups on a weekly time frame. Okay, I see 3 or 4 questions about the corn market. Well, that's going to be interesting. Let's take a look at corn. Be really honest with you, I've been in Montana with my grandkids and kids in the backcountry. I haven't looked at corn for a while, so this would be interesting for me to look at as well. Ooh, well, first of all, we see that blue line has been coming up. We know those guys tend to be buyers at market highs. And oh my gosh, look at the small speculators. They're really bullish up here. Is it any surprise that corn has come down? So, you know, that's kind of the way I look at these things. The small speculators got really wildly bullish in here, and they tend to be wrong in the marketplace. So I would expect this market will pull back. The commercials have gotten out of the market. They're not doing any buying in the marketplace. So until they come back in, look, buying in, we rally. When they
This is Ben from eSignal. It looks like audio feed. Hello, folks. Let's give Larry a few minutes to reconnect by audio. I'm assuming he's probably having some audio difficulties right now. Okay, folks, I have a feeling Larry's trying to restart Adobe Connect, which should retrigger his audio setting. So bear with us. I hope you are enjoying today's webinar with Larry Williams. Let's give him a few more minutes to hop on board, okay, folks? Yes, folks. Everyone who is in attendance will receive a recorded copy of today's webinar, and I'm hoping there's a little bit more of it if we can get Larry to join us anytime soon. Tom, yes, we do offer a free trial period for eSignal. It's a 30-day risk-free trial. Um, if you want to take a look at it, I'll send you that link right now. Oh no, so I just got an email from Larry's marketing team. It looks like his computer has crashed. Folks, he's trying to reboot right now, so he's trying to get back. So hopefully you guys stick around for a little bit. Grab a quick drink or bite to eat, and he should be on soon. Yeah, so the way it works for those of you asking about the free trial of eSignal, so once you go to that link, you'll be downloading the latest version of eSignal, which is again version 12.2. And then once you go there, there's an option for you to add on Larry Williams COT indicator for a 60-day trial for you to test drive. It's a very generous offer. Most partners usually offer anywhere from a 14-day or 2-week period to a month period, but Larry has been gracious enough to work with eSignal to offer his indicators for a 60-day trial. So again, you can't go wrong with that. It's a great opportunity for you to give the indicators a good 2-month drive. So Daniel, saw your note right there. It is a charting platform, but we're integrated with over 100 broker partners. So again, if you have a broker you're working with, by all means, continue working with them. But if you're looking to explore and check out, obviously, pricing with other broker partners, please take a look at the eSignal platform. Malin, you can run it on a PC primarily. In terms of a Mac, you can emulate it. So if you're familiar with setting up an emulator on your Mac, then you can run eSignal. So, Kaz, your question, you're referring to why is eSignal available for a 30-day risk-free trial versus 60? That's kind of our best offer right now. We wanted to make sure that people get a good 30 days to give it a try and then go from there. Pavlin, good question. That is something we could definitely bring up to Larry and see what we could do to partner up in terms of additional product development. But if it looks like people want to give his indicator a test drive and then go from there, then by all means, if we hear a clamor for more products from iReallyTrade, then definitely by all means, I'll work with our biz dev team to engage Larry and his team. So Roy, I'm not sure if you saw the link I sent you, but the free trial of eSignal is available here to learn more about it. And again, for those of you who have any questions regarding Larry's COT indicators, here is the product page as well. Gordon, Chromebook. I don't know per chance if it will work on a Chromebook. You might want to do some research onto that if there's quote unquote emulators for Chromebook, but I've never gotten that question before. Traditionally, it's only been on PC, and then for those on Mac, on the Mac platform, they use an emulator to use it. Oh, Leslie, I don't know if you saw the first link I have, and I'll send it right here again. So yes, Pavlin, again, after the 60-day trial for the COD indicators, it will be a subscription-based service for $35 US per month. Huh. Daniel, that is a question you need to be asking the iReallyTrade team regarding Larry's cracking the money code. Definitely, if there's a clamor for it, we'll definitely chat with Larry to see what we can do to port it over. Do you offer a free trial of advanced get? So Birdsley, that's your question right now. I do know we're running various specials. I think one right now is a 30-day trial also of advanced get. So if you go to esignal.com and do a search or go through our product section, you'll have a link to get to our advanced get page and see what is being offered. Let me read your questionnaire. So if I'm a new Signal East customer, I get a 30-day free trial. After 30 days, I need to pay, but COD can continue for another 30 days. Correct. That is correct. That's why if literally today, if you sign up today for eSignal and also went ahead and signed up for indicators, you get eSignal for a 30-day risk-free trial. Get the COD indicators for 60 days risk-free. Jason, yes, all attendees will be receiving a recorded copy of today's recording in a follow-up email. The open interest indicator, that is a good question, FT. I don't know. If you're unsure, you might want to give our customer service team a call and ask them. Okay, it looks like Larry's starting to respond. I'm going to see if I can get him to get his audio back. So for those of you who graciously stood on, let's give Larry a few more minutes and hopefully we can get him back on.
Ben, can you hear me now?
Larry, welcome back. Hey.
Hey, thanks very much. Sorry about that. We had a computer. Can you believe that?
Yeah, no, Larry, I've been trying to kind of entertain the audience, do a couple, side jokes and whatnot. Just kidding.
Well, you're more
just kind of
entertaining
asking
than I
questions
am, that's
about
for sure.
just asking questions about your con indicators as well as eSignal. So by all means, if you want to restart your presentation from where you left off, let's go ahead and start it.
Well, okay, we'll go back to the chart. So we're going to share my screen. So we're connected. Adam, can you hear me now? Hello?
Ben from eSignal, we can hear you just fine.
Okay, good. Yeah, a couple questions came in. Yeah, the principles of my 1970 book are just very valid today. I mean, the time frames have changed. We have different markets, but you know what? Commercial are still the big guys in the marketplace. They figure out what the market do. So they're way ahead of us. So yeah, the old still work well. Okay, it looks like we're back on. I don't know where we last left. And again, I am really sorry. I apologize. Like, not very professional. So please, not what we had planned. I missed the whole explanation before the PC crashed. Okay, you can hear good. Okay, well, I mean, it's really simple. There are ways you can make this COT stuff more precise and more finite. You can go to my books and all this stuff over that, but in a 1-hour webinar, it's a lot of material to cover. This has been my career for a long time period. But the general observation is high levels of small speculator buying are associated with market peaks. Low levels of commercials buying are associated with market peaks. High levels of commercial buying are associated with buy points in the marketplace. And we can then look at that with open interest because we see who's causing open interest to move. So most of you heretofore have just looked at the COT indicators. They're good. I use them. But I think there's a lot more to learn from actually looking at the net positions of these guys. So I think somebody was interested in the corn market. Maybe that's where when we crash. So let's go back to corn. And then I think we'll probably take one more market and wrap it up from there. Certainly people have more important things to do than listen to an old man talk about charts. Oil, we talked about crude oil. We looked at what was going on there. I don't know that if you mean maybe heating oil or soybean oil. Oh, thank you. I didn't notice that. See. Okay, here's corn. And somebody wants to look at a currency. We can look at currencies, and we'll do that in a moment. We haven't looked at any yet. I think maybe we looked at this. This looks familiar, or maybe this was soybean meal or oil. But we see the same thing happening. Commercials get long, markets bottom. Commercials get long in here, markets bottom. And look at the interplay over here. Commercials are buying, and the large traders are getting out, and open interest is, well, who's causing open interest to rise? Commercials, then open interest plummets in here, doesn't it? But the commercials are the driving force of open interest. That's the buy setup. Commercials must know how to plant stories. The commercials aren't, they don't do that at all. You people are paranoid. This is not how markets work. Markets are driven by people setting price points because of their production. Remember, the markets were not set up for us to trade. We're an afterthought to bring liquidity to the market. This is a commercial venture. If they can grow wheat at one price and sell it at another, they're going to sell it. They don't care if it goes higher. They made a buck at it. All this mysticism of the markets, 99.9% of it just does not exist based on my limited years in the marketplace. That's what I'd have to tell you. Let's see, there was a market somebody wanted to look at. Hey, live long and prosper. Absolutely, Star Trek. Stock. We were going to do a currency, weren't we? So let's do a currency. Somebody type in what currency you want to look at. That's one of the fun things about what the market is. NSD. I don't know if we have that with commitment trader data. That's New Zealand dollar, right? NSD, right? F. We can't do. We can only do a contract. So New Zealand dollar. I never looked at this one. This should be fun if we can get it. We can do the Canadian dollar. Remember, we can't look at a spread contract. Invalid symbols. That's not going to work. So let's go to this. Let's look at somebody wanted. So we'll do CD. The Canadian dollar. Okay, here's a Canadian dollar. So what are we going to do? Well, we're going to look and see what those guys have been. Remember, they're the driving force of the marketplace. And Marshall, we will do the Australian dollar, and we'll finish on that. We're waiting for late. And does public open interest work with E-mini? The E-mini, I prefer to use other things as a short-term trader. As I mentioned earlier, it works as well as we'd like to see. I'm not getting the data to populate for the Canadian dollar, so maybe we will go to the US dollar. Let's try that. AD, I know time's running short and I don't want you guys here all day long. Does COT account for possible spreading of positions? Yes, it certainly does. Okay, so now we're going out and getting the commitment trader data. And we're just waiting for it to populate. And yeah, it should be online. So here's a question. Would your core calculation behind the COT oscillators is a percentile placement of the net positions? All I'm really looking for in all of the COT stuff is to see when there's preponderance, when there's a bias one way or the other. So the indicators can do that. I don't know why we're not getting it to populate. Let me. Now we lost my chart. That's not going to do it. I can pay. So yeah, all of the markets work with the commercial data, and for some reason, I'm not getting what we want. So I'm going to end this. We've gone through enough all along. You guys and gals, if you get a 60-day trial, like I said, try to verify, right? Download this stuff. Use the general observation that I've given you as a starting point. You can go to our website, ireallytrade.com. I do a weekly market commentary called Larry TV, where I talk about this in depth every week. You should be able to get enough going by now. Oh, stock market second half of 2015. Yeah, you're going to be shocked at what happened to the stock market. First of all, the bears are wrong. We're not in a bear market. We're in a bull market. And the Cassandras are going to be proven wrong again. We're going to drift down in here to a buy point. That's Larry Williams' view. A good place to wrap up for now. I'm so flattered that people come listen to me talk about the market. So thank you very much for being here. I hope I've been able to increase your understanding of the markets a little bit. God bless every one of you. Good luck, good trading to you. Stick with conditions, trend changes, entries, and stops. The market's not a rigged game. It's a game for intelligent decisions. Till next time to you, and good trading.
Thank you, Larry. Appreciate your time here. And again, folks, let's go ahead and formally conclude this webinar. Hello, it's Ben from eSignal. I'm out of a scheduled time with us today. I'd also like to thank all of you for coming to today's webinar and hope you found it useful for your trading needs and educational needs. And a reminder, you will be receiving a recorded copy of today's webinars. Thank you for attending. We hope you have enjoyed this webinar and will join us again soon. Again, thank you on behalf of eSignal. We hope to see you again. Take care.